Hey there, everyone. My name is Ryan Schul. Welcome to my data science channel. So in the project today, I want to show you how to compare multiple techniques for triggering buy or sell signals based on stock price moves. So this topic was in the back of my mind for, for quite a while. I haven't really had a whole lot of time to really give this thing a lot of attention until just recently. So I tested some ideas in the last couple of days, and I'll show you what I came up with. I think it's fascinating stuff. So hopefully you can stick with me to the end, and I can guarantee it's going to be totally worth it. Okay. So there are several techniques to experiment with when trying to determine the optimal price for buying or selling a stock. We can look at support and resistance levels. That's topic number one. I'll show you how to do that. Relative strength index. That's topic number two. Number three is moving average crossovers. Okay, we're going to look at 20-day moving averages and 50-day moving averages. Bollinger Bands, they're called. This is one to put in the buy price if the band crosses the lower bound, and sell price if the band crosses the upper bound. And MACD, which is moving average convergence divergence. So this is the moving average over time of the stock, and our stock price is converging and moving together, or they diverging and moving apart. And that's what we're going to see. So we're going to pull in some historical price data from Yahoo Finance. If you've seen several of my videos, I guarantee you've seen something like this already. We're going back in time 12 months. The current date and time is being picked up from the machine right here that I'm working on my laptop. This date time is now, where the relative time back is 12 months. The start date will be the current date time, and the end will be the date time plus the time delta in days, okay? So start time is let me see, the current date time now, start would be date time now minus relative data is the current date time. Okay, yeah, so we go back this way. So we go back 12 months, that becomes the current date time. This is the date time. 12 months back in time, that's the start, and the end is basically yesterday, okay? So we start in 6/26/2024. Now it's 6/26/2025. So we go back exactly 12 months. That's what this is right here. And we have all of the historical stock price data for the Dow 30 components. So the only thing that we need to change here to do your own analysis is really just a couple of things. The tickers that you're analyzing, I'm looking at the Dow 30 and how far back in time you want to go. I like 12 months. It really depends what you're doing. And the frequency of your trading. Maybe 6 months or 9 months is more appropriate. In this scenario, I think 12 is more appropriate. If you're looking at like big picture data, big moves in data, or certainly like macroeconomic types of indicators, micro or macro indicators, you'll probably go back years in time, right? I don't think 12 months is going to be enough because those things get measured quarterly. But for stock prices that come to us daily, I think 12 months is totally sufficient. So I'm going to go ahead and create the first plot here. And there's a lot of code here, guys. I'm not going to trick you or try to desensitize the importance of this thing here. There's a lot of stuff going on. But again, the only thing you'll have to change is what I showed you. A couple of variables, the inputs, the tickers that you're looking at, and the time that you go back. How far back in time. You can look at 18 months, you can look at 24 months. I think 12 is good in this case. So there's only a couple inputs that you would need to change. So what's a support and resistance level? Did I define that already over here? Yeah, I think so. So identify the support and resistance levels from rolling minimum and maximum closing prices over time, and then the trigger buy if the price drops below the support level, or sell if it rises above the resistance level. So I just plotted these charts right here. So the resistance level here is in red, the support level is in green, and here's the stock price for Apple. So if I zoom in, these are all plotly charts, so it's very dynamic and interactive. If I zoom in, you can see all the details here. So Apple tends to trade within the resistance level. So a couple times it hits the resistance and then bounces down. Remember, resistance is on the top, it's red, and the support is on the green on the bottom. So if I go out a little bit, why is it not refreshing my graph? I think it's just too much stuff here. Okay, it's got it. Yeah, or did it? Let me just refresh the thing just to make sure. Okay, so we're looking at support and resistance levels. These are calculated with window size of 30, and we're going back in time 30 days, 30 trading days. Okay, it's not 30 calendar days, it's 30 trading days, the days that the market was open. And we're looking at a rolling min and a rolling max. So if I do Control F, the max goes down here, right? That is going to be the resistance level, and the support level would be the min, right? Control F, Control C, Control F. So the support is the minimum. If you think about it, the support is on the bottom, that's the minimum. Resistance is the maximum, that's on the top. We are creating a plotly chart based on price data. The index is the date, and the support level is the y-axis, right? So that's the up and down, the vertical axis. And we go ahead and plot the chart. If I expand this, you can see everything relative to everything else. So here's Apple. It actually trades above the resistance level for quite a bit. The resistance is red, and it goes below the support just a little bit, but it tends to stay within these bounds, right? The support and the resistance, or at least within the resistance. So that's reassuring. We have a high confidence here that if we invest in Apple, it's not going to go below the support level, except in this case right here for a short period of time it actually did. But for the most case, it does not, right? Let me double click that and get back. So this gives me pretty decent confidence that it's not going below the support level, although it could, it certainly could. You know, I think my computer's too slow. Let me refresh this again. Right, it will respond to that. It doesn't respond to me just zooming in and zooming out. Okay, let me expand this thing again. So here's the first trading strategy, support and resistance levels. I think it's still running. Yeah, so running. You can tell by the hourglass in the upper left-hand side, but it's pretty fast. So it'll take a few seconds to finish off here. Okay, and now we can expand this. So we have the support on the bottom, right? That's the red, and support is on the bottom. That's the green, and resistance is on top. The red tends to stay above the support, and it breaks out from the resistance a couple of times. This stock tends to do about the same, and that's okay. This stock, so this one is a little bit more wild. It's going below the support level quite a bit, and just kind of hits the resistance a little bit and kind of like trends down again. So that's AXP. I forgot what AXP stock is. This is Boeing, B of A. B of A is Boeing. So again, kind of a riskier stock. It's going below the support level quite a bit. This one, Caterpillar, is all over the place. CRM, I think that's Salesforce, not sure. Cisco, this is Cisco. So again, below the resistance level. And these are set at 0.7 and 0.3, right? So if you look closely, rolling window 30, right? And again, the support level is on the bottom and the resistance is on the top. I don't see how I define that. That's okay. That's okay though. Okay, but anyways, you can see most of these stocks stay between the support and the resistance level in most cases, right? CVX is a little bit wild child. This is Disney, so that's kind of bouncing all over the place. But it gives you an indication of like how confident are you that this stock price is going to stay above the support level. Like if it breaks out above the resistance, that's fine if you're long. If you're short, that's not good. But most people go long, right? There's not too many people out there that do short trading. So as long as it stays above the support level for most of the time, I think these are good stocks. This one right here, Honeywell, probably not. That's below the support level quite a bit. This one, IBM, that's all over the place. So this Intel, I think INTC is Intel. So that conforms with the requirements for the support level. I think that one is good. This one, it's pretty close, Johnson & Johnson, but a little bit scary. JP Morgan, not really behaving. This is going below the support in this too. Triple M, this is Merck, Microsoft, Nike, Procter & Gamble, TRV, I forgot what that is. This is United Healthcare. So most of the time it's above these support, the resistance level. That's okay. So we're making some good money. And it tends to hit the support level and bounce back. So I think that's fine. This support resistance level is pretty tight. There's not much margin there. And then we have Walmart, okay? So that was the first example of the first trading strategy. Let's move on to the second. That was, oh wait, no, I'm down here. Sorry. Let me get back. Yeah, my computer's getting old too. So let me hit refresh. Let me save it and then hit refresh. I always like to save these things pretty frequently. It does save automatically, but I lost one a few weeks ago and had to rebuild all the code. That was painful. So there's no guarantee it's going to save before the crash, but I did have one crash. It does save on a pretty regular basis though. And you can probably set that in one of the settings. I don't even know how to set it, but it's probably set to like 15 minutes, every 30 minutes or 15 minutes, I guess. I'm just guessing here. I don't know for sure. So here's the historical prices coming in. there's the relative support and resistance, right? SNR. This is the SNR strategy. So the next strategy is RSI, so relative strength index. So again, this is going to be similar to relative to the last one we looked at was support and resistance. So this is the SNR. RSI is going to be similar to SNR, but with a few slight differences. So again, we have the mean going back in time, and we're looking at a rolling window with average gain and average loss, and we're trying to return the RSI, the relative strength index, okay? So we'll get the RSI between these 2 points, the average gain and the average loss, and we're going to plot the results just like before. So the RSI index, again, is the dates. If you look over here, the index is right here, date. You can see that the date is kind of down a little bit one level from all the stock tickers up one level. So this indicates that this is an index. If the date was on the same level, like if the date was up here where ticker is, these are all on the same level, then the index would be 0, 1, 2, 3, 4, 5 for the row counts of the data frame. But in this case, we set the index to be the date. So the date will be on the horizontal, the RSI value will be on the vertical. And let's go ahead and plot this. So Control Enter to run it. The RSI measures the speed of change of price movements. It ranges from 0 to 100. Above 70 is overbought. This is a potential sell. And below 30 is oversold. This is a potential buy. So that's the RSI. Let me compare that to the relative strength. So the relative strength says a price level where a stock tends to stop falling and often bounces back up. So RS is bouncing back up, represents increased demand, buying pressure. Traders see it as a floor. If the price drops below this level, it's likely to rebound, or a buy signal if the price touches the support. Traders may expect a bounce or consider buying. Okay, again, so the relative support, the green is the support level, and the red is resistance. So with RSI, it's slightly different. We look at ranges above 70 is overbought, below 30 is oversold. So it looks kind of similar, but different, slightly different application of the logic here, right? So the oversold is kind of like the floor, and the overbought is kind of like the ceiling. So this is support, right, green, and the resistance is in the red. So the math is a little bit different, but the concept is very similar. Support, green, resistance, red, oversold, green, and overbought, red, right? So if I expand this, we'll see Apple. We'll see the same general, exact same stock price pattern, right? But similar but different support and resistance levels. This is called overbought and oversold. So support would be on the bottom and resistance would be on the top, right? And you can see a lot of times it stays within those bounds. So with the relative strength, that was calculated automatically for us. In this case, we're setting these bounds to be 70 and 30, right? So this is where it comes in. And let me see, Control F70. Yeah, so here the the lower bound is 70, and then the 30, overbought. Oh yeah, overbought, right? And oversold. Okay, so the support is going to be 30. This is like 30% on the downside, 70% on the top side. So we're assigning these quantitative factors to this. This is going to be the resistance. This is going to be the support. In the relative strength example, those were calculated automatically, right? With the, with the support resistance, those were calculated automatically. With the relative strength index, we're assigning a numerical representation of that, right? So 30 and 70, this is what all the plots look like for all of the stocks in our entire universe. So we have about 29, right? So that's what the stock charts look like. Let me condense this, right, to shrink it down a little bit. Otherwise it gets unwieldy. And I think my computer is just definitely getting too slow and too old here. I can't get to refresh. So let me save it and just force it to refresh. Okay, let's give it a second here. Yeah, overwrite, that's fine. Okay, so overwrite this. And waiting for the confirmation over here. 4 seconds ago. Okay, so we're good. I don't think I even made any changes. So it's probably a moot point. Okay, so let's get back to the analysis. We have support resistance and relative strength index. So we saw two strategies so far. Okay, and we are going to see 3 more in just a moment here, so stick with me. Okay, it's coming up. Struggling, guys. This laptop is old. I think I'm due for a new one pretty soon here. Okay, and okay, that's what I want. So we can continue on here. So support resistance, right? That's the support resistance. Relative strength index, that's number 2, RSI. So let's just compare quick. What it measures based on scale and interpretation, support resistance, price levels where buying and selling pressure emerges, past price extremes, local highs and lows, same scale as price, and horizontal levels where price may bounce back or reverse, relative strength index, momentum of price changes, average gains or losses over a rolling window, always between 0 and 100, and oscillator shows if price is overbought or oversold. So the next concept that we're going to look at, or next strategy, is moving average crossover. So similar to the others, we have a rolling window here. The short window is 10, the long window is 30. So this is a little bit like going back in time, 10 trading days. What happened the last 10 days is pretty important. If you go back in time 30 days, that's also important. But the longer you go back, the less important it is, right? What happened 1 or 2 weeks ago is more important to what's happening today than what happened a month ago or 6 months ago or a couple of years ago, right? If you go back in time 6 years, 5 or 6 years, it doesn't matter too much. If you go back in time 10 days, that matters more, right? So we have the short window of here, Control C, Control F. The short window goes here, the long window goes here. So the short moving average is here and the long is here. So we're shifting back in time 1 period, right? And we're saying if the short moving average greater than the longer and the short moving average shift back in time 1 day is less than the long moving average, this is a crossover up, okay? So the short moving average is going up, it's trending up. If the short moving average is going down, right? So in the last couple of days, it's going down, it's less than the longer moving average, and the short moving average shift 1 is greater than the long moving average, just as a crossover down, okay? So we're looking at crossovers up, crossover down, similar to the support resistance, similar to the RSI, but slightly different strategy here, right? So again, we're looking at price data index. That is going to give us the time, and the price data is going to give us the vertical axis, so the actual prices. So a fast moving average is 10 days, reacts quickly to price changes. A little bit slower is 30 days, smooths out long-term trends. If the MA crosses above the slow moving average, this is bullish. It looks like the stock is trending up. It's going up in price, right? If the moving average crosses below the slow moving average, this is bearish, and this is a sell signal. So let me expand this. So now we have exactly what we had before. It's the stock price for Apple. We have the 10-day moving average and the 30-day, and then we have the indicators here. So bullish crossover gets a green triangle, and a red triangle down is bearish, right? So I can see a bearish, bearish. Here's a bullish signal over here, and I think another bullish signal over here, okay? So let me zoom out. And then, of course, we have the 10-day moving average and the 30. So the 30 is a little bit more smoother, right? It's taking the average of 30 days. The 10-day moving average is a little bit more choppy, right? But not as choppy as the stock price, because the stock price is every single day, every change over time. So moving average for Apple, Amgen, AXP, and you can see here, right? When you zoom in, you can see green triangle means buy, red means sell. So here's a buy signal right here. There's a buy. This is actually a buy, but it goes down. So it's not always correct, right? This is a sell, but it's going up. Here's a buy going up. Here's a sell going down. So that's correct. And let me zoom out. So you can see a lot of these signals are pretty accurate, but there's no guarantee whatsoever that if you get a bullish crossover signal, it's going to mean it's time to buy. And if you get bearish, it's time to sell. There's no guarantee in the finance world or in the investment area, right? But this does help you make more informed, more intelligent types of decisions, right? But again, no guarantee of anything whatsoever. So just rebuilding the charts. I zoomed in. I probably shouldn't. My computer is a little bit kind of tired at this point. I've been using this thing for several years. Probably due for an upgrade soon. So more moving averages, right? For each stock, we have the 10-day, 30-day, and then the bullish crossover and the bearish crossover. So this is the third strategy, moving average. So we had the relative strength. support resistance, relative strength index, moving average. Okay, let's look at the next strategy. Go up a little bit. So I'll go up a lot. Okay, we skipped ahead a little bit. That's fine. MACD, and there's one before that. Okay, Bollinger Bands. So this is the fourth strategy. So we had MAs, RSIs, and SRs. So the next one, Bollinger Band window is 20 and 2 days. Okay, so the window is 20. Control C if I go down here. So the window is going to move 20 days back, and we're going to take the average of that. And the standard deviation is going to be 2. And that is a rolling standard deviation for an upper band and for a lower band. So simple moving average minus the standard deviation is going to be the lower band. Simple moving average plus the standard deviation is going to be the upper band. And again, we're looking at price data index. These are the dates, and the price data is on the y-axis. So these are the values. So let me hit Control Enter to run it. Okay, and let's see what we get. So now we have the Bollinger Bands. And let me see, I can expand this. When it's done running, this will expand. Okay, so slightly different approach. We had the RS, RSI, and then the, what was that? Sorry, I already forgot. Moving average. What was this other one? Yeah, moving average. Yep. Okay. Here's Bollinger Band strategy. So you can see here the stock price exactly in blue, exactly what we saw before. The middle band is the SMA. This is in orange. The upper band, so this is the higher confidence interval, is in red. The lower confidence interval is in green. And you can see the delta here. You can see the spread between the red band on the top. This is the upper confidence interval. Green is the lower confidence interval. The blue is the stock price. And the middle band is the simple moving average. Oh, it's going to do that again. I'm not even going to refresh it, okay? Because this thing is starting to get me a little bit frustrated. The laptop just can't keep up with the requests here. But anyway, so we have the simple moving average, upper band, lower band, overbought, oversold. And you can see over here on these X, I'll just do it again. I know I'm in for a punishment here. So this is overbought and it's coming down. This is overbought. This is actually incorrect because it goes up. But then the next trading period, it does go down. This goes up and goes up a little bit, but then it goes down, right? Let me see if I can find a couple examples of oversold. Oh, here's one right here. This is oversold. But these are false signals. This says oversold, oversold, oversold. So if you buy in here, right, you're going to lose some money between here and here. But then, you know, this is oversold, so it starts to go up again. Here is a false signal, so it's oversold, oversold, and oversold here. Then it goes down a little bit, but then it jumps up, right? So it's pretty accurate. But again, no guarantee, and it's not 100% accurate. You can see here, this says overbought, but it keeps going up. Finally, it's overbought and it's coming down. This says oversold. So this indicates a good time to get in. But if you actually did this, you would lose a lot of money because you get in at about 294, then it goes down to 254, right? So you lost $40 per share in a couple of days, right? So the strategy tends to work, but not all the time, right? You can see there's exceptions to the rule. So Bollinger Band for Boeing, this is Boeing, Caterpillar, so on and so forth. Okay, so now this is a fourth strategy. So we had relative strength, support resistance, relative strength index, moving average, Bollinger Bands. So let's move on to the fifth strategy here. This is going to be right here. Right here, MACD. So moving average, convergence, and divergence. So I mentioned this just at the beginning. This is, again, looking at the moving averages over time, but these prices will tend to converge and go back to an average. If it's way down, it's going to go back to the average price. If it's way up, it's going to come back down, right? So that's the convergence and the divergence. So the divergence is moving away from the mean. The convergence is moving back to the mean. We set an exponential moving average of 26 days, right? And we're looking at a span of 12 days going back, and that is going to be the exponential moving average 12, exponential moving average 26. So going back about 2 weeks, this is going back about 4 weeks, okay, or 12 days and 26 days. That's what that represents, okay? And we're looking at the moving average shift back 1 day, and then we're going to test right here if the moving average previous is less than the signal and moving average is greater than or equal to the previous signal greater than or equal to the signal, this is a cross up, right? So it's going to come up, the stock price is coming up if the MACD previous is greater than the signal previous and MACD is less than the signal, then the stock is probably coming down, okay? So that's the concept here. Again, we are looking at the price index, which is dates, and Y, MACD is values. Hit Control Enter to refresh the cell. Takes a couple seconds. Now we have the actual stock price in blue, MACD, the signal, and then the buy signal or the sell signal. Okay, so let me expand this as soon as it's done. So if I zoom in a little bit here, you'll see the buy and sell signals. Buy is a green arrow up. This is a buy. This is sell. So this is a signal down. So this is correct. It's going down, 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 down. Then the signal comes in because these rules are triggered over here, right? So if you look at this, cross up, MACD previous less than sell signal and MACD greater than signal. So the MACD moving average convergence divergence is going up. You want to buy it. If it's going down, MACD previous greater than the sell signal and the MACD is less than the signal, then it's going down. So that would trigger, or that would indicate a sell signal, right? So hopefully that makes sense. I know it gets a little confusing, but if you read through the notes I created a couple of times and run your own experiments with this, it should totally make sense, right? So again, stock price in green, in blue. Starting to get tired here. MACD in yellow. The signal is the dotted line buy and sell, right? We see that over here. Let me zoom in on this. So sell is down here and actually goes up a little bit. Then we have no signals. Then we have a buy signal, but then it goes down, sell signal, and then buy signal as trending up. Okay, so again, a lot of times pretty accurate, but there is no guarantee whatsoever that you're gonna make money with these strategies. And by the way, I'm just showing you the finance, the mathematics, the statistics, the economics here. I'm showing you the strategies. So if you invest in this and lose money, don't try to sue me. Don't get angry with me, right? The market is a finical beast. It's very finical, very finicky. Finical is finical word? I'm sorry, finicky. Very finicky, very temperamental, right? So you have to do investing at your own risk. I've tried these strategies. I've made money. Sometimes I've lost money too. And when you make money, it's a great feeling. You think, oh, I'm so smart. I'm smarter than the rest of the traders in the market. I'm making a ton here. If you lose money, you think to yourself, that was somebody else's fault, right? Like, I'm the smartest one in the game here. That's somebody else's fault. So it's just human nature to think that way, and that's totally fine. I understand that. But again, this is not a financial recommendation. These are only describing 5 trading strategies and the math and the statistics behind these strategies and how they work, right? But there's exceptions to the rules. So if you engage with these strategies, you have to be prepared to sometimes lose money. For the most part, these strategies are profitable and they will pay off. Better than just throwing a dart at the dartboard and trying to pick a stock randomly like that. But if you're making money every single day, day after day after day, then if this was true for everyone would be a multi-billionaire, and obviously not everyone is a multi-billionaire, right? So you have to take this with a grain of salt, but I think the theory and the concept is very fascinating, right? So using moving average and crossovers when looking for simple trends, entry and exit rules, use Bollinger Bands when accessing overbought or oversold conditions, and use moving average convergence and divergence when you want momentum, confirmation, and trend signals. So the moving average crossover gives us trend changes, moving average costs, short and long, trend following trend reversal points. Bollinger Bands give us volatility and price, deviation, price, touches on bands, SMA, and standard deviation, mean reversion and breakout, price extreme volatility, and MACD focuses on momentum, trends, and trend strength. MACD crossover signal, fast EMA economic, exponential moving average, slow EMA trend following and momentum, and trend detection and momentum. It's a lot. That's a lot, guys. So we can backtest trading strategies and compare the return. So when you backtest something, you take it back in time and you go back a certain period and say, okay, if we didn't have the last 2 weeks of trading data, if we cut off what the model saw 2 weeks ago, can it make a forecast into the future for the next 2 weeks or 4 weeks, whatever duration of time you pick? And what are the returns that the model is predicting relative to the actual returns that we actually got in the market for that period that you're reviewing? It could be a week, 2 weeks, 4 weeks. It's kind of arbitrary. It's really up to you what you decide. So I'm going to look at the total return percent. I look at the daily returns, the strategy returns, which is the daily times the position, and then the total returns and the total return percent. Okay, so we're looking at the Sharpe ratio. This is very important for all kinds of traders, portfolio managers, asset managers, investment managers. The Sharpe ratio is the strategy return minus the risk-free rate. In this case, we're saying the risk-free rate is 0. So you can argue, is it 0? Is it slightly more than 0? It's always very small. It's very diminutive. It's de minimis. What's it called? Diminis? It's small. It's tiny. Okay. So you can say it's 0. It can be a tiny fraction of a percent. It's not a big number. If we set it to 0, I'm fine with it. This is the mean return. You divide by the standard deviation. So you want your strategy returns divided by the spread of the returns over time. If you have a high return and a small spread, that's going to be a very high Sharpe ratio, very profitable return on the portfolio. If you have just an okay strategy return and a big spread, so if the denominator is big and the numerator is small, the Sharpe is going to be small. If the numerator is large and the denominator is small, you're going to have a high Sharpe ratio, right? So that's how that works. And we're going to look at the cumulative return. This is a cumulative product of the strategy returns. Rolling max is a cumulative max. The drawdown is a cumulative minus rolling max divided by the rolling max. So what is the maximum that you can lose in the portfolio? That's the drawdown, that's the drawdown. And then the max drawdown is the minimum times 100. Okay, so that's a mouthful. I'll admit. So I'm going to share all this code with you guys. I'll give you all the code. You can chew on it, digest it, take the code. When I post this video later today, you can download all of this Python code as an HTML file. I'll share it with you because it's a lot, right? It took me a long time to put this together. I had to do a lot of debugging. At the beginning, I had some weird results. The code ran, but it gave me some nonsensical kind of price forecast. So I knew something was wrong. So it took a long time to get through, but you can do it, right? You can absolutely do it. So here's the 5 strategies: support and resistance, RSI, relative strength signal. We're looking at less than 30. That's a support, greater than 30, greater than 70 as a resistance, right? So this concept and this concept is similar. This is the moving average signal. Again, short moving average greater than long. This is the buy. Short average less than long. This is a sell. Bollinger Bands, again, we're looking at the moving average and the standard deviation of prices. If the lower moving average plus 2 times the standard deviation plus the moving average, this is the upper Bollinger Band. Moving average minus 2 times the standard deviation, this is the lower, right? And then the 5th strategy was MACD, moving average convergence and divergence. Again, we're looking back 12 days and 26 days. 12 minus 26 is the moving average convergence divergence, and we're looking at signals. If the MACD is greater than the signal line, then the stock is moving up, right? The trend is up, and MACD is less than the signal line, it's going down. Okay, so that is the concept. So let me go ahead and run that to put that in memory. We are going to create a dictionary of strategies. So Bollinger Bands, MACD, RSI, crossover, and support resistance. Okay, and then I'm going to create a small function here to look at the price and the signal. We're looking at positions, daily returns, strategy returns, right? These are the 5 strategies: Bollinger Bands, MACD, relative strength index, moving average crossover, support and resistance. And based on the strategy returns, we're looking at total return, the Sharpe ratio, cumulative, rolling max drawdown, and the maximum drawdown for the whole portfolio. That's the maximum you can lose on the portfolio. Okay, and we're looking at the trade logs and the trade returns. So we'll take all of the returns. We have the original strategy in a dictionary. We're going to take all the returns as a key value pair, total strategy return. This is the key, right? Here's the value. Here's the key on the left-hand side of the colon. If you look closely, here's the key on the left-hand side. The value is on the right. So this is our second dictionary. And then we're going to create everything into a summary data frame and look at the strategy, total return based on strategy percent, trade percent, Sharpe ratio, max drawdown trades, and the time in market. So we have the summary data frame here, and this is the final result of everything. Everything is displayed here all in one place. So we have the strategy, the total return. Okay, in this case, total return, the best was the MACD. The worst was the moving average crossover was the best. MACD had the worst total return. Total return percent was actually Bollinger Band. The worst was MACD. Oh no, the worst was support resistance. Okay. Sharp ratio, the best sharp is MA crossover. The worst is MACD. For maximum drawdown, the worst is MACD. The best is, these are all going to be negative, right? Because this is, you have to lose some money at some point. Otherwise, it's called monotonic, and the portfolio is only increasing. We went back 12 months in time. I don't think any portfolio never has a down day. Like at some point, you're going to have a down day. I heard in the news or something, I read some articles about some hedge fund never had a down day in 3 years. That is phenomenal. If that's true, I never validated that, but that would be amazing if that was true. I don't know if it's true or not, or if they're just looking for some attention from the media. But if you never had a down day in your portfolio in 3 years, that's fantastic. Typically, you'll have a few down days at least, and maybe several. So here's the number of trades for that entire strategy and the time in the market in terms of percent. So sometimes you're invested. Sometimes if there's no good opportunities, everything is sitting in cash, right? So if there's no good opportunities, the percent of your investment in the percent of the investment invested in the market could be pretty small. If there are a lot of opportunities, the investment in the market could be pretty large, right? But at some point, some of your money definitely will be in cash. So here are the 5 strategies. So support resistance, RSI, MA, Bollinger, and MACD. So let me go ahead and run this and show you what the results look like. So MACD says we have 11 trades in this period. So if I go over here, MACD signal looks like this. So this part is a little bit cumbersome, but just be careful with it and you're going to get some results that totally make sense. Actually, I already have the MACD. This is the MACD strategy. You can see right here, we have 0 through 10. There's 11 trades over the past year. Okay, that matches this 11 right here, this 11 trades. If we look at another strategy, what performed pretty well? Bollinger Bands had just 2 trades within the year, but Bollinger had a total return of 18%. Right, so a lot of the time we're actually out of the market. We're not even invested, but we were invested 2 days that produce a pretty decent return. So if I go over here, put MACD Bollinger Band signal over here, Bollinger Band signal cleaned. So I don't want cleaned. I just want to rename the beginning of this right here from MACD to Bollinger Band. These are going to be the trades, MACD trades, MACD trades. So we said there's 2 trades, and we saw the returns. Control Enter. So this is like the trade blotter. You can see this is the evidence of the trade. A trade was done on 8/5/2024. The buy price is 208. The sell price is 232. And it was August 5th that the trade was entered into. It was exited 9/30. And this was the sell price. This is buy price, so 11.47%. And there's another trade done 11/4/2024, exited a couple weeks later, 11/26, bought at 221, sold at 234. The percent return was 5.99. So total return 18.15, sharp 0.49, maximum drawdown negative 1.3, pretty tiny. 2 trades done at time in the market was 1.99. That matches what you see over here. Let's look at one more example. What was good? Total return strategy here was 5.7. This is the MA crossover. Let me show you how this works. So MA signal, Control C, Control V. So we're going to put MA signal down here. Now we want signal cleaned. Okay, so this function that I created over here is going to clean up the signal, because sometimes you can enter into a trade and the trade is in the market and it's working for you, right? You're making money, hopefully not losing money. But until you exit that trade, you don't have confirmation of the full cycle of the trade, right? So you have to look when the trade goes into the market and when you make an exit. That is a full trade, right? So you have to kind of clean up these trades a little bit, because if it goes in and the money is still invested, you don't know if you made a profit or loss, because you didn't claim your sell signal. You didn't confirm the sell signal yet, right? So Control C, Control V, MA signal. That goes over here. This goes over here from Bollinger signal to MA signal. I have to type it in. Okay, so we get MA signal trades and MA signal trades. Control Enter. So we have two trades, 7.74, 1.63. The total return, 5.7. So if you go over here, moving average, 5.7, that's exactly what we see in this chart. So this chart is nice because it shows you the holistic universe of all your trades and all your strategies in one spot. The Sharpe ratio is 1.1, so anything over 1 is good. Maximum drawdown is a little bit negative. You always have some negative, and the time in the market was about 1.5% of the time. Total return 5.98, and we should see that over here. MA crossover 5.98 is the total return. So that's a lot. That's a lot of stuff. But if you play around with this a little bit and get acquainted with it, it will become more intuitive and much easier to comprehend the concepts here and to make sense of all this stuff, right? And like any kind of memory muscle, if you do this over and over, you can get pretty used to it pretty quickly, and it's going to make a lot more sense. I understand the first time you see it, it's like, what the heck is going on here, right? It's very overwhelming. It's very convoluted. It's a lot. It's a lot to digest. But I promise you, if you spend some time with it, it's going to make a lot more sense. Again, there's no guarantee of a profit here. I'm not giving you investment advice. I'm telling you from a math perspective, stats perspective, finance perspective, investing, portfolio management, asset management, and investment management, hedging. This is how the strategies work. I can't guarantee you're going to make money, so don't try to come after me. Assuming if you lose money, this is how the strategies work, but you have to make it work for yourself. Okay, these are all independently executed and transacted on your own behalf. Like if you make money, I don't take the money. I don't take any profits. If you lose money, that has nothing to do with me. I'm just telling you the strategy. So in conclusion here, we have support resistance. We have signals, right? Here's RSI, relative strength index. This is the MA crossover. And then we have the Bollinger Bands, and finally MACD, moving average, convergence, divergence. And we can go ahead and take all of these comprehensively and look over time. We went back 12 months in time and look at all the trades. So this shows us like a microscopic view of the moving average signal, right? But if you want to see all the trades for the past year all in one spot, like you see all the returns here, right? This is a very nice view right here. I like this a lot because you have all 5 strategies, all the total returns, the strategy returns, Sharpe ratios, maximum drawdowns, trades, time in market, percentage of the entire year. This will show you every single ticker, last trade signal, recommended buy low target and sell high target, right? So this is pretty nice. You see Apple, buy it at 199, like 200 if it goes to 200, or recommended price, buy at 195 and sell at 204. So this is right in between. This 288 is in between 273, 302. So if you're looking at JP Morgan, you see the stock is at 273 right now. That could be a good buy. If it gets up to 303, sell it. Let me see what JP Morgan is doing right now. Finance. I got to take a break after this one, guys. So JP Morgan. Yep. Okay. So right there. So let's see what this is. Should we buy it or sell it or hold? There's only 3 outcomes here, right? So we said JP is 273 or less, buy, 303 or more, sell. Or if it's over 303, don't even get into it. Okay, 288. Okay, so it's right where it needs to be, right? So 288. So that's the recommended price. So I would just say hold, don't buy, don't sell. Let's look at another one. United Healthcare, the average recommended price is 304. If it's 293 or less, buy, 315, sell. So UNH, let's look at that. Is it below 293? If it is, buy it. UNH. Show me UNH. 05. So that's right in between, right? So do nothing. Microsoft 495. Microsoft 495. Oh, wow. Oh, yeah. Okay. Didn't refresh. I was like, whoa, what the hell? That's a guaranteed buy. That's a definite buy. 493. JP Morgan 493. So right in the sweet spot, right? But if it goes below this, we buy it. If it goes above that, sell it. Can I find any that's good buy? Caterpillar 379. Cat. $378. Okay, so these prices are just right in line with where they should be, right? So Walmart, one more 696.84. WMT. We're almost done, guys, so hang in there. I need to take a break too. Walmart is 96.68. It's right in the sweet spot, right? So 96.8. So if it goes below 93, that's a buy signal. Above 100, that's a sell signal. And let me save this here. I think this was the end of my notes. I want to do a refresh. If I get the end indicator right there at the bottom, then this is it. I always put an end with an exclamation point at the bottom, just so I know it's the end and not like, did something get cut off? Is this the end, or did somebody make a mistake? So I just explicitly say that's the end. Okay, and let me see what comes up here. Okay, and of course I'm going to share all this code with you. I'll post this video a little bit later today, and I'll share all the Python code with you. I'll share the notebook as an HTML file. I'll save that as HTML. So let's go down. Why is it doing that? Oh, I didn't have focus on here. Why is it? Oh, okay, whatever. Okay, yeah, that is the end. So this indicates the end, very explicit. So anytime these stocks go below the target, that's a buy. Above the target, that's a sell. Again, this is not investment advice. I'm just explaining these 5 strategies. The relative strength index, support resistance, moving average, Bollinger, and MACD. These are 5 very popular trading strategies, typically very lucrative, very profitable. There are exceptions to this, right? There's no guarantee whatsoever, but I think it's fascinating. And this is definitely the finance, the stats, the investment philosophy of how these things work. It's not investment advice. It's just the long and short of how everything works. And it's the true truth, right? That's why I call this channel Straight Data Science, straight up truth. This is the truth. This is how it works. This is the straight stuff, guys. This is it. So I'm going to wrap it up here. Thanks for your time. Thanks for sticking with me for 47 minutes, actually a little bit more than 47 minutes. We'll wrap it up right here, and I'll see you guys very soon in the next video. Thank you for your time. Take care. Goodbye.